Today is an exciting day for me. If you've been a subscriber of mine for a while, you know that I've been a precious metals investor since the late 90s, and I've done very well at it. The videos I've put together were a summary of what I've come to learn about the metals, and my hope for all of you was that it could put some tools into your investment toolkit to help you make your own decisions about where to place your hard-earned wealth. It's been frustrating for many who have had to endure the last few years of price correction starting in 2011. Until now, all I've had to say is that I did not know exactly when the shift of confidence would occur that would cause the gold bull market to resume. However, I'm ready to make that call now. I'd like to work you through the thought process and show you what I expect to take place over the next decade. I have to give you a bit of a disclaimer first, though. This is only what I think is going to happen. You're going to have to make your own mind up. Also, this is not my prediction for the coming week, month, or even year. It's only a long-term prediction, and so you'll have to sit and be patient if you want to enjoy the result. What you see in front of you is an important chart that I use for assessing the health of the US dollar. It shows the ratio of outstanding US debt against the reserves held. Unlike other governments whose reserves are primarily the currencies of other nations, the US reserves are primarily deep storage gold. This is because in the present world economic system, the US dollar is the global reserve asset. It is well known that ever since Nixon closed the gold window in 1971, gold has been a non-callable asset. In other words, prior to 1971, when trust in the US debt declined, gold would flow out of the US vaults, putting pressure on the US government to revalue the dollar against gold to protect its gold position. Now, instead of gold flowing out of the vaults with an occasional revaluation of the dollar, the gold is stagnant, and the dollar is continuously revalued against the gold held in storage. What we can see here is a century-long increase in confidence in the US and its ability to issue and pay huge quantities of debt. It started with the ascendancy of the US as an industrial powerhouse and continued until the year 2001, which was the peak in US power and influence. Confidence in the US has been on the wane ever since. One of the most important points in time to note on this chart is 1944, which was the start of the Bretton Woods system. Leading up to this point in time, the gold from Europe, seeking safety from the results of two world wars, flowed into US vaults. Ultimately, this culminated in the Western world reaching an agreement that the gold would remain in US vaults and the rest of the nations would accept and use as monetary reserves the currency issued by the US government. This was a sea change in the monetary system and is important to keep in mind because if confidence in the US is lost, the amount of debt the US will be able to issue relative to its gold in storage will look more like the left-hand side of this chart than the right. And it will be gold revaluing that causes the ratio to revert back to where it once was. Notice how before Bretton Woods, the ratio of US debt to gold in storage varied between 2 and 10. When confidence in the US was high, the US could borrow 10 times the collateral that it had in storage. When confidence in the US was low, it could only issue twice the debt of the collateral that it had available to back that debt. Think of it like a person borrowing a large sum of money to buy a home. Traditionally, a person would need to put down about 20% of the assessed value of the home to qualify for the loan without mortgage insurance. This would be similar to a ratio on this chart of 5 to 1. If the bank only required a 10% down payment, it would be like a ratio of 10 to 1. And a ratio of 2 to 1 would be similar to the bank requiring a 50% down payment for the loan. Notice, though, that after Bretton Woods, the US has enjoyed, as Charles de Gaulle once put it, an exorbitant privilege. Only once since the start of the Bretton Woods system has the US needed more than 10% liquid assets to be held against its debt. This was in the year 1980, when confidence in the US to service its debts was nearly lost. In this year, the ratio shown on the chart plummeted to a low of 5.5, similar to our home buyer, who needs to have at least 20% equity in his home for the mortgage to be considered sound. Will we get back to that point again? I think the answer to that is yes. Maybe think is the wrong word. I am highly confident that the answer to that question is yes. The 1970s were a very important period of time. Leading up to 1971, the debt of the U.S. was climbing at an alarming rate due to the guns and butter programs of the LBJ administration. and the world was losing confidence in the U.S. ability to service all of its debts. So there was a drain on the Treasury gold caused by the Western world, led by France, exchanging their dollars for gold. Nixon stopped this process in 1971 and set in motion a very large revaluation in the dollar against gold. Remember, ever since 1971, the gold stopped being mobile, and changes in the confidence in the dollar started manifesting as a repricing against gold rather than as a flow of gold out of the Treasury vaults as had been done in the past. Over the ensuing 10 years, the world saw the ratio of U.S. debt to the market value of gold in its vaults plummet from 32.6 down to the 5.5 level that I mentioned earlier. This caused the market value of gold to rise from $35 per ounce to $613 per ounce. Many cite $850 as the true high for the gold market, and they are right to do so. But I'm using yearly averages here because I think that they are more meaningful for our purposes. Now, if you're observant, you are probably asking yourself the question, if the ratio changed by a factor of 6, then why was it that the gold price increase was 20-fold? The answer is simply that the U.S. continued to issue new debt all throughout the 1970s. And this is a very important thing to keep in the back of your head, and I can't stress it enough, because although the dollar will reprice itself in fits and starts against gold, there will always be an upward pressure on the gold price as long as the U.S. issues more and more debt. This is why over the past 5 years, as the price of gold corrected, I was never concerned about gold as a long-term holding. One should also notice that in the middle of the gold bull market of the 70s, there was a big correction. Some, who were the victims of unfortunate timing, saw the price of their gold holdings decline significantly, and some by nearly 50%. Does this sound familiar? It's similar in magnitude to what we've experienced for the past few years, but the person who had the courage to stay the course enjoyed the ride from the correction low of $100 per ounce all the way up to the 1981 peak. Those who lacked the perspective and patience to ride out the correction missed the main show. And in 1980, it looked like the faith in the U.S. currency was well on its way to collapsing. There was a run into gold and silver, and the price of gold and silver shot up. Part of the price increase was loss of purchasing power of the dollar, but the majority of the price increase reflected a very real appreciation in the purchasing power of gold and silver. But then in 1980, something changed of a very fundamental nature. Many claim it was Volcker who broke the back of inflation in 1980 by increasing short-term interest rates to the high teens. Certainly this was part of it, but there was another very large development that went unnoticed by many. This was the dawn of the age of gold derivatives. The central banks, in coordination with the bullion banks and the mining companies, unleashed a large supply of paper gold and silver. The gold and silver was sold forward in the futures market by the mining companies who needed cash in order to develop their mines. Thus, the gold and silver futures were sold, and they were backed by future mining production. The bullion banks participated by creating a means for private gold and silver bullion holders to lend their metal into the market in return for cash flow. The central banks backstopped the market to provide confidence to futures buyers that if the mines were unable to deliver, the central banks would be there to keep the market liquid. This very large increase in paper gold and silver supply was enough to take the pressure off of the physical gold and silver market, and the very large interest payments available in the debt markets took additional pressure off of gold and silver, and so their price fell. It fell for a period of 2 decades, all the way from gold's yearly average price in the 600s all the way down to the high 200s. While this was occurring, the U.S. was able to expand its debt because there were very many more people now willing to buy its debt. The ratio of Treasury debt to Treasury gold went from 5.5 all the way to a peak of 82 in 2001. Talk about an increase in confidence in a country's ability to service its debt. Talk about irrational exuberance. But unwarranted confidence is always ripe for a fall. And so in 2001, we started what, in my opinion, is a long-term secular trend change, where people's very notion of what wealth is changing. While in the 90s, those who owned a bunch of numbers in a computer system, in other words, financial assets, considered themselves very wealthy, it will be those who own the real ounces of gold and silver in the future who will be considered the wealthy ones. And it will simply be a change in perception that makes it happen. Nothing more. It will be the idea of wealth which will shift, and as a result, the purchasing power will flow from those who own financial assets to those who own the assets which have no counterparty risk and which cannot be simply conjured into existence without the expenditure of large amounts of energy and labor. And we've seen the warm-up phase of this trend change. The ratio of U.S. debt to Treasury gold fell from a high of 82 in 2001 to 36 in 2011. And during this time, gold revalued in people's minds from the high 200s to the mid 1600s. Again, a yearly average. This six-fold increase in gold's price was very similar to what happened to the price of gold in the early 1970s, though it took longer for the adjustment to take place. Though, like any secular change, nothing goes in one direction indefinitely. Too many people bought gold and silver heading into the year 2011, and the price got away from itself. Most of the buying pressure came from people speculating in gold and silver who were inexperienced players in the paper market and bought on margin. They didn't own real gold, they weren't interested in owning real gold, they didn't even know what real gold represented. They were trying to ride the trend in price for a paper profit. As a result, they were targets for the professionals who were able to use their sheer strength and size to run the price down and trigger stop-loss orders. The speculators were forced out of their positions, and this caused the price of gold and silver to crater. The revaluation of gold caused the ratio of Treasury debt to Treasury gold to climb back to a level of 62.4. Not quite back to the peak of paper market exuberance seen when confidence was high in 2001, but pretty darn close to it. Compare this to the action in the early 1970s. You'll see that it's very similar, albeit not quite as compressed in time. But now I think the corrective phase has run its course. The speculative longs who lost their shirts are now gone from the gold market. I'm sure they'll be back. Paper has a way of luring ignorant people into doing foolish things. But for now, most of their attention is on riding the trend of record highs in the stock and bond markets. In the meantime, the ratio of Treasury debt to Treasury gold has fallen back to a level of 55. Still very, very high, and the trend downward has now resumed. So where do we go from here? I think the answer lies in our trend away from globalism and towards nationalism. As we move back in a direction towards independent nations, we'll likely see the people demand a return to monetary sovereignty. It will start with the fracturing of Europe, and the trend in motion will eventually lead to the U.S. losing its world reserve currency status. It may take some time for it all to play out, and it will certainly be chaotic, but we'll eventually get there. In such a world, we will see each nation, including the United States, only able to extend a small amount of credit relative to the amount of liquid reserves that it holds in the form of physical bullion. Somewhere between twice and 10 times liquid assets, as we saw prior to Bretton Woods, will not be unreasonable. So I think it's likely for the ratio of U.S. debt to the market value of Treasury gold to fall back to 5.5 to 1. This was right in the middle of the range established prior to Bretton Woods, and it was the level we hit in 1980 when it looked like the U.S. would lose world reserve currency status. If it weren't for the opening up of the gold derivatives market, we'd probably be there right now. Personally, I think the derivatives market effect has run its course. Many years of gold and silver production have already been sold forward. It will really be up to the buyers of long futures contracts and ETFs to decide whether taking the risk in paper gold is worth the perceived convenience factor. If the ratio drops from its current level of 55 to the 5.5 target that I have in mind, we will see a big adjustment in the gold price. You can forget about the $1,500 targets being published right now by those who use technical analysis to decide where to put their money. If your goal is to ride the price to $1,500 and then realize a paper profit, I'd suggest that you're not seeing the big picture. You need to think about monetary history and understand what the implications of a trend reversal from globalism back to nationalism would mean for the metals. Assuming the U.S. issues no further debt, which is a highly dubious assumption. A move in the ratio from 55 back to 5.5 would mean a tenfold revaluation in the price of gold. This would take gold to $13,500 per ounce. If confidence in the dollar took a bigger hit, then the price of gold may get as high as $37,000. Bear in mind that some of this change will reflect a decline in purchasing value of the dollar, but quite a bit of the change will be an increase in the actual purchasing power of gold. I personally think, based upon demographic trends and unfunded U.S. liabilities, that the debt of the U.S. is going to be quite a bit higher over the next decade. But that's a subject for another video. So to summarize, I'm making a call right here and right now. The corrective phase that we've seen from 2011 to the end of 2015 is over. We could see some further price weakness in the metals, but the long-term secular trend of loss of confidence in financial assets is set now to resume. Over the next decade, we will see a trend towards nationalism and a trend to much higher levels in the gold price as the idea of wealth shifts from paper claims towards real possession. Those who patiently accumulate and hold on to gold should be quite pleased a decade from now. It's time to go full dragon mode. Be right and sit tight. Build and protect your hoards.